the subject at hand and talk about this final exam. I hope that you will not let this thing, be a drain on the things that really matter in your life, because I know it probably seems like a final exam matters, but I also know I'm talking to three people who are old enough to know that in the grand scheme of things, an accounting final exam is, well, if we're going to be honest, it's just dumb. It matters because you want to do well, but there's so much more that matters, so much more than a test. For one thing, the knowledge matters, right? When we are fitted to be of more service in the Lord's kingdom because of things we've learned and grown through, then tests are sort of silly. But that being said, we want to do well on the test too. So, okay, I don't know, I'm all like weepy tonight, so sorry if I've, all right, so let me share my screen. And how do you want to do this? Do you want to just take a look at this? I mean, do you want me to walk through every point of it, or do you have specific questions you wanted to ask about it, I guess?
So I was looking at these, it's got like 7 pages for this exam, going over all this stuff. And it's right at the beginning, it says it's designed to assess your understanding of the concepts covered in chapters 9 and 10. But it says, but however, it should be viewed as a comprehensive exam. But then when you go to 9 and 10, it's like 2 tiny little blurbs for 9 and 10. So I'm like, is it really focused on 9 and 10? Or is it focused very comprehensively?
No, it's a good question. So about half of the exam points are 9 and 10, and about half are the rest of the chapters.
Okay.
Oh, okay.
Okay, so it is both, I guess. So something like about 30 questions on each.
Okay.
Recognize that chapters 1 through 4 are really they never stopped. In other words, they taught you a concept, but then you were still continuing on with journal entries, adjusting entries, and then the financial statements, and sort of the relationships that occur between the permanent accounts of the balance sheet and the temporary accounts of the income statement all throughout. And so that's why there's this whole like critical review, right, of each thing that they start with. And so like you got to know the financial statements, and you've got to know them, for lack of a better term, like backward and forward. Like you got to understand how revenue and expenses and net income, if someone gave you the expenses and the net income, you should be able to calculate what the revenue was, like how they interrelate with each other. You got to go know that the net income impacts the retained earnings on the statement of retained earnings, that in addition with the beginning retained earnings and any dividends that the company paid, right? And then you've got to know that the balance sheet, how the balance sheet works. Again, if it leaves out one item on a balance sheet, like cash, but you have the total liabilities and total equity, you should be able to calculate the total assets, and then from total assets be able to calculate what the cash was. In other words, understand them that well that you can fill in blanks, because they like to do stuff like that, those jerks, right? Those I wonder if there's some guy like that works at McGraw-Hill that's like, has like an evil guy laugh from a movie, like, oh, this one's gonna be hard,
Seriously, I feel like even when they put it in the tables, they put it opposite the way you're supposed to answer the questions, just so it'll confuse us and make us put it in the wrong spot. I am just like, people, don't be mean. I want to believe that the world is full of people and not just cruel people trying to trip me up.
Right. Yep. No, it's an interesting thing. So, like when I've tried to have this discussion, I'll go to national conferences there's actually a national organization called Teachers of Accounting at 2-year colleges. It sounds exciting, I know. And you'll go there and there's kind of like 2 different camps or 2 different philosophies. And one is that sort of what I call no surprises testing, right? Try to make your exams look in format very similar to what the homework looks like. And then there's the other side, which is like, it's the surprises where you separate out the A's and the B's and the C's. Maybe everybody passes, but it's the person who can deal with those things presented out of order and things like that, who really understands it deeply. And I don't disagree with that theory. But I also feel like sometimes it catches out people who do understand the concepts well, but for whom exams are kind of fear inducing. And so they're just not in their best, clearest mind, who would make a fine accountant, but in the moment of an exam like that are feeling almost manipulated by the way it's put together. So I'm in the no surprises camp, but I don't get to design the course. So
So in the last test, I decided that I needed to write down. So I showed my paper to the screen that it was all blank. And then I wrote down the things, because in the one before, I felt like they kept tripping me up. And then I would be like, wait, I can't think this clear. And so it was better for me to have it written down on the notepad, so that I could at least look at it and say, no, this is the way, this is the debit, and this is the credit, and not get mixed up again with, I don't know what's secret.
I do the same thing.
Yeah, Marta, I have to write it out. I write out every single one as I read them, so that I can so that I know I'm visualizing it right.
Exactly.
Because otherwise I can't. If that's the only way I can keep it straight, is to write it out as I read every single one.
Yep,
Well,
and I do too, just so you know. When I see these kids that I work with and they're like, oh yeah, I'm getting it all in my brain, and you're like, well, good luck with that, buddy, because it gets more and more complex, right? And you just need to keep it all straight. So you're not alone. I always try to write out my steps and try to do things in a stepwise fashion. I think it's kind of part of being good at accounting is learning how to identify steps and then flow through those. Anyway, so revenues, I guess, again, I don't want to read this out to you. I want to make sure that you understand revenues. I think an important distinction is the difference between a revenue and an unearned revenue. Mostly because an unearned revenue is not a revenue at all, it's a liability. And so that's confusing to people. Just recognize it happens all the time. Like I own a storage, well, I sold it last year, but I owned a storage business for years. And it was normal for people to pay us in advance for a whole year's worth of storage rental. And so I couldn't just call that all revenue as if I'd earned it all. Instead, they were kind of loaning me their money, right? They were giving me their money interest-free, which wasn't wise on their part, but I took it nonetheless. And then we recorded it as a liability. And then each month as I earn it, I do an adjusting entry to reduce that liability and increase the revenue, because I'm earning some of it each month. So that's an important distinction that I think catches people, even people who are good at it. They just see revenue in the name and they go, oh, revenue. Recognized revenues are increased with a credit, decreased with a debit. And the most common type that you'll see will be something like service revenue or sales revenue or rental revenue. Those are the most common ones you'll see in real world application, I guess. Recognize that we recognize revenue. That's confusing. We recognize revenue when we earn it, not necessarily when we get the money. That's an important distinction. I don't know how much background noise there is. There's a whole bunch of high school kids walking through, and all I can say is yuck. All right. I love them, but there's a reason I teach college. I think I could do kindergarten or college, like nothing in between. Middle school, I would probably be in prison if I taught middle school, because I would have killed some kid. That's a tough age, man. My baby is a sophomore in high school. I'm so glad that we don't have middle schoolers anymore at the house. Okay. There's a little, I can see some amens, some nods of assent.
My oldest is just getting there. She's 7th grade. And so I'm like, oh, I'm just hitting those years. So
do you have any boys?
I do. My middle 2 are boys. So I've got a girl, 2 boys, and a girl. So
because there's all the same attitude that girls have with the boys, but then there's the smells of the boys too. So that's I mean, my daughter stunk a little, but the boys reek. Okay. This is just facts. Okay, maybe I don't know. All right, we better keep moving here. So expenses, same idea. We recognize an expense when we incur it, when we actually do the thing that makes the expense happen. That's a little confusing. In other words, sometimes we pay for something in advance, but we don't recognize it as an expense until we actually use the good or service that we purchased with that money. A good example is like when we buy supplies, right? We record them as an asset until we use them, and then once we use them, we record that as an expense upon the use or the incurring of that. Let's see if there's anything else here that I didn't think anything else was really crazy. And again, jump in if you have some sort of a thought or question. Assets, stuff we own. I think the most confusing asset that we see in here is the prepaid expenses, because again, it has expense in the name. It's an asset because it's something we own. Okay, so if I pay in advance for rent or insurance, then what I've done is purchased the value, I guess, of those of that insurance in the future. And so I record it as an asset. When I pay for it, my cash goes down, my asset prepaid insurance goes up, and then at the end of each period, as I use up some of that asset, I record it as an expense at that point. So that's a big one. And then I think the other thing that sometimes confuses people is like recognizing the depreciation of long-term assets, equipment, buildings, things like that can be confusing, and the idea of book value, which will come up in a future chapter here. But so those are all kind of important things. Liabilities are money that's owed to you. And again, we've just finished some chapters that go much more into depth on liabilities. If you notice, that's how the course was laid out, right? It introduced these concepts, and then it gave you chapters that went like drilled deeper into what assets are and how we handle them from a depreciation standpoint, or cash and other short-term assets, more deeply into liabilities, long-term debts, short-term debts, things like that. So, and then equity. So equity is hardest for people, I think, because it's less tangible. Like, what is equity? It's the difference between your assets and your liabilities. Remember, assets equal liabilities plus equity. And the reason that's true is because what you own minus any debt is what actually truly belongs to the owners of the business. The equity is what really belongs to the owners, okay? It's the stuff the business owns minus any debts it has. And so there's really only two ways to create that equity. One is what I call contributed capital or contributed equity. That's where the owners put money into the business. That happened when I started my business. I put in half the money, my mom put in the other half, and then I was partners with my mom, which was a mistake. I love my mother, which made it hard to be partners with her. Especially because she would drive by the business and be like, hey, I noticed some weeds out there in front. And I'm like, we're 50-50, man, go pull them. But it's my mother, so I can't actually say that. So instead, I'll just be like, yeah, I'll get the boys over there.
I'll
like,
get them. I'll get them.
yeah, I'm like, well, we're 50-50 here. Like, I have no more responsibility for those weeds than you do. But it's my mom. So
I did have a question about this. So like revenue and expenses are temporary accounts that are they're temporary equity accounts, basically, right? Because they close into retained earnings. Retained earnings is the equity account. Yes.
Right. Yes.
So when we're looking at that, like, are they not technically equity accounts? Are they just kind of there and we don't look at them that way until it's closed into retained earnings?
Yeah, so I think there's two different takes on it, and that's why textbooks are confusing on it. Okay, I dislike considering them equity accounts because if they are, then expense is a negative equity account, right? Like it's so that's confusing, I think, and dividends too, right? Dividends, and so I tend to like to see them as their own category of accounts: revenue, expense, and dividend. that are just temporary in nature. They're kind of a holding place where I record any revenues for a period of time, and I record any expenses for a period of time, and any dividends, and then they're going to be closed out and returned back to zero. So whether they're equity accounts or not, I it's like, again, like, what would a nerd debate? That's something they would debate, right? Like probably if you try to debate that in front of some big jock guys, they would just give you a wedgie.
Okay.
Because,
So,
because,
but like, because we have questions like this in assignments and on the quizzes where it'll say, you know, given this, it does this to assets, this to liabilities, and this to equity. And
right.
it'll be like, with this account, it increases or decreases it by this amount.
Right.
You know, so you would have like an expense that it would say decreases equity.
Yeah, and so recognize in the way the book spells it out, what it does, the expanded accounting equation. So it'll be revenues, you know, which, so the accounting equation is assets equal liabilities plus equity. The expanded one is they'll do assets equal liabilities plus revenues minus dividends minus expenses, right? And so in that, and then plus common stock, right? Or so in that sense, the authors of the textbook consider those as related to equity.
Okay.
But again, because all retained earnings is your revenues minus your expenses minus any dividends. In other words, the money the
What's
business
left.
brought in through operations minus any money paid out through operations minus any money paid out to the owners. That's what retained earnings is. It's the earnings that were retained in the business, which is obvious, except for it's not. I don't know. Does that help at all?
Yeah. So yes,
Okay.
that does make sense.
All right.
See, that was
So
the last quiz from last week, right? I kept trying to put it in the liabilities column, but I think that in the end, I realized that it's got to go in the equities column. And because the equities column was off the page, it was harder to even remember that the equities column was
Had to
so I kept
over to it.
Liabilities, saying, no, this is the liability. It's a merchant, whatever it was, that it should have been in the equity account. According to textbook editors, I think.
Yeah, well, and surely from that perspective, if we're categorizing it as either an asset or a liability in equity, then clearly it's part of equity.
Okay.
Revenues and expenses and dividends. Anyway, so and so chapter 2 just goes more into depth on that. You know, again, this is where we learn about debits and credits and normal balances and all those things. So again, you know, hopefully we have those down. If you feel weak in that area, you know, you need to review it. Just remember that the normal balance is the side that increases the account. Because to me, then you don't have to memorize it anymore. You just say, you know, so if you know the debit and credit rules, then you'll know the normal balance rule too. This little process for journalizing is something to this day, after doing this for a long time, 30 years, I still do. Okay, I do it super fast because I've done it over and over and over. But I seriously, each time I'm going to make a journal entry, I say what accounts are impacted. I classify them. Are they asset, dividend, expense, or liability, common stock, or revenue? I determine, is it increasing or decreasing? And then I apply those rules. I do that. I still do that even now. So again, I like to put things into steps, right? If I go through these steps, my journal entry will be correct. And then once you can create a trial balance, you should be able to, from a trial balance, create an income statement, a statement of retained earnings, and a balance sheet. Which kind of leads us into chapter 3. And that's where they get into the idea of adjusting entries, right? I think I really feel like adjusting entries is one of the hardest concepts for everybody who's first learning accounting. It's even something that like the software makers, like that make QuickBooks and that, they don't really adjust for or account for. And so still often you'll have people who are trying to do their own books, but not realizing, oh, I shouldn't have recognized all of that as an expense or whatever. How do you guys feel on adjusting entries? I don't want to spend a ton of time going over them. If you feel like I got this part, or I'm willing to go over it a little bit if you do feel.
This is the week I got COVID.
That was bad timing on your
It
part.
was really bad timing. And so I struggled. And so what I'm doing right now is I'm going back through all those supplemental concept videos and
Okay.
I'm going through them again. And tonight's chapter 3.
Okay. It doesn't help that like on top of you had COVID, I don't know if it did this to you, but it like fogged my brain up for like a year.
Oh, yeah.
Yeah, I'm
Like-
still,
Like my ability to do mental math and stuff like that was impacted. And to remember people's names, which is tough when you have a bunch of students who are like, you don't know me. I'm like, I'm sorry. I've turned stupid recently. Okay.
yeah, it's humiliating.
You know what it reminds? Oh,
750
sorry.
Yeah, yesterday, 750 days. How many months is that? How many years? Could not do that math. I had to
Right.
come home, eat dinner, and then yeah, it's embarrassing, but it's real.
Well, you know what it reminded me of is my wife, anytime she would be pregnant or nursing,
Oh,
she couldn't think clearly like that. Like
Pregnancy brain.
yeah, it was like I said, I think I know how you felt all those years. Like
Yeah.
seriously, she was pregnant like the first 20 years we were married. So it was like I was like, I could swear I married an intelligent person, but I don't.
yeah,
And now
no.
she's smart again. Now that she's a grandma, so she was always smart. Okay.
Yeah, I was gonna say, be careful.
Yeah, no, I think the hormones or something, and there must be something going on with COVID that it seems like it does that to our brains. So recognize. I think if you can recognize with adjusting entries that adjusting entries always have to do with when the cash and the incurrence of an expense are separated by time. Okay, in other words, we never worry about adjusting entries when I say purchase something and immediately claim it as an expense. It's always when there's some separation of that, like I pay money in advance, but it's going to be an expense later because I'm not going to incur the expense. Or also with revenues, if I earn revenue now, but I'm not going to get paid for it until later, that's going to require an adjusting entry. Or if I get money now, but it's not going to be recognized as revenue till later, then that's also going to require an adjusting entry. And adjusting entries only occur at the end of a financial period. And so those rules, and then also that there'll never be cash in an adjusting entry. Like if you just know that, it'll help you to not make some of the most common errors, because if you're doing an adjusting entry and you've try to put cash in there, just recognize you're doing something wrong. You're making an error. So those basic rules about adjustments to me really help. So again, it's either I got money now and later on I'm going to earn it as a revenue. That example would be like my storage, when people pay me in advance, but it won't be till later that I'm going to recognize it. Or the other is I earn revenue now. I do the work for somebody and I've earned it, so I need to record it, but I'm not going to get paid for it till later. And again, that only becomes important to record because I'm at the end of the financial period and I need to show the revenue I've earned during the period. And so that's when I do my adjustments at the end. With expenses, it's either I have incurred the expense now, but I'm not going to pay it until later, or I paid for an expense now, but I'm not going to incur it until later. So those are the 4 circumstances that lead to adjusting entries. And it's something I think I should do better at teaching. But it seems like it's one of those things. It's like trying to explain a card game, and everybody's like looking at you like you're crazy. But after you play a couple hands, you're like, oh, that makes sense. So it's almost easier to explain after the fact. Anyway.
That helped. Thank you.
All right, into chapter 4. This is where they break out a single step income statement from a multi-step income statement. And really all that means is a multi-step income statement has more details. Also, typically multi-step are used when we sell products as opposed to do services. And so sorry, that keeps giving me, maybe I should open it in Google Docs so it quits being dumb. I think quits being dumb is appropriate grammar. I don't know. Let's see. I'm just gonna, sorry, now it's taking forever to scroll. Anybody ever watch the Jetsons when you were younger? And George Jetson would George Jetson would come home from work and he would be like, "How you doing, honey?" And she'd be like, "I've been pushing buttons all day." And I think that's where we're at. We're like, I freaking had to scroll forever. It was ridiculous, or whatever. We're so weak. All right. All right. So we're back to, oh, that's not awesome. I think it looked better in preview mode. Okay, hold on. Sorry about that. We'll just have to deal with it occasionally popping up with the Google Docs. So there we go. So revenue minus expenses gives us net income. Sometimes instead of just saying less expenses, it will have all the expenses listed out. Okay, but that's still a single step income statement. A multi-step income statement, kind of the feature of it is that it will have cost of goods sold and gross profit. Some of them will have the net sales broken out where it has the less sales returns and allowances and less sales discounts. Other times it will just say, it'll even just start with net sales. So the big feature, I guess, for determining if you're dealing with a single step or a multi-step is this having cost of goods sold, gross profit, and then having like operating income and then other incomes, other income and expenses. That's kind of what makes it multi-step, is having all of those, you know, different types of expenses, cost of goods sold, operating expenses, and then other expenses separated like that. If you ever use like Microsoft Money or Yahoo Finance, you can look at the income statements of businesses in there, and theirs I love because it starts as like a single step almost, and then you can click on each category to expand it to see more. I wouldn't say I love was a strong word. I find it a useful tool. How about that? I don't pine for it when I'm, you know, not looking at it. Down in Mexico, don't have good internet, and I'm like, I wish I could look at Yahoo Finance. We had something, right? So I don't love it. Anyway, so okay, this right here, put to memory the following. Oh, you silly thing. Okay, the following formula for computing total costs of goods available for sale and cost of goods sold. So this relationship where we go beginning inventory plus purchases plus the cost of freight in, less purchase returns and allowances, and less purchase discounts gives us the total cost of goods available for sale. You're going to have some problems on this exam that want you to do that. Really, if you think about it, all it's saying is any stuff you already have, plus the cost of purchasing and transporting the new stuff you bought, minus any returns that you have on it. That's going to tell you the cost of what you have available to sell to people. And then what you have available for sale minus what you have left over at the end of the period is going to be all the stuff you sold during the period, or the cost of goods sold. So that's an important relationship. What I have plus the cost of getting new stuff is my cost of goods available, minus what I have left over is what I sold, the cost of goods sold. The summary cheat sheet for chapter 4 is a good thing to review if you have time. I like those summary cheat sheets at the end of each of the chapters. Personally, I think they're good tools. But we all have, again, limited time. Again, know how to prepare a classified balance sheet and a multi-step income statement. By a classified balance sheet, I mean one that breaks out assets into current assets, and usually they'll call it property, plant, and equipment, or sometimes they'll call them long-term assets. It breaks out liabilities into current liabilities and long-term liabilities. So that's a classified balance sheet. Again, just it breaks all those same accounts, it breaks them down into more categories. And again, for me, when I'm a user of that financial information, I like additional detail. There's a difference between a company who has $1 million in assets, but they only have $1,000 in cash, and the other 999,000 is a building or something. Their solvency is probably in question if all their money's tied up in that building. So that's an important distinction for my brain. And then understand what 310 N60 means. So this notation for payment, I guess payment discounts, right? That means that the seller is offering the buyer a 3% discount if paid within 10 days, or net, meaning the total amount, the whole amount would be owed within 60 days. So your choices are get it for 10% off within the first 3 days. And if you don't do that, then you have up to, I guess, 57 more days after that, to the 60th day to pay the whole amount. And there's all sorts of versions, right? 110, probably the most common you'll see is like a 110 net 30. That's pretty common. Most people like to be paid within 30 days. Our biggest employer in our area here is a big copper mine, and they require all people who work with them to allow net 120. And so whenever I'm advising small businesses who want to work with them, we have to build into their plan 120 days of operating costs before they start getting paid by the mine, right? And that's tough if you have 75 employees. What's 120 days of? Anyway, so it's tough to be a contractor for the mine. You got to have the money to float it. All right. I know I'm talking fast. Interrupt me again if you need to, or if I don't know. Anyway, know the difference between these three inventory systems, okay? The weighted average, the first in, first out, and the last in, first out. And again, this is costing under a periodic system. And a periodic system, what that means is we're not keeping track of our purchases and sales throughout the month or throughout the time period. We're waiting till the end and then assuming either an average cost where we would add up the cost of, we'd add up the total cost of all the inventory we purchased and the total number of units, divide the cost by the units to get an average, and then apply that. Say the number of units sold times that average cost would be our cost of goods sold, and the number of units sitting there in inventory at the end would be our inventory. First in, first out. That assumes, again, the first thing we purchased is the first thing we sell. And last in, first out, which in my brain is the weirdest one, because I grew up in a retail store, and in a retail store, you always try to sell the oldest stuff first, right?
That's actually a typo. It says last in, last out, but it should be last in, first out.
That is a typo, yes. Last in, first out. Otherwise, it would be Lilo, and then we would probably have to pay royalties to Disney. So yeah, it's last in, first out. Thank you. Nice attention to detail. You should get extra credit, but I'm not allowed to give extra credit. It's very frustrating that I'm not allowed to at all. And then people will email me, they're like, is there anything I can do? And I'm like, I'm sorry. And then they're just like, you're a horrible person, or they don't say it.
It's not me.
I am a good person, but the accounting department, horrible people. No, they're good people too. They're just trying to strive for some consistency, right? Otherwise, you'd have teachers that'd be like, oh, of course, we'll drop 3 worst exams or something, which that'd be awesome.
Yeah.
Understand the meaning of FOB, which is freight on board, origin or destination. So again, that has to do with when ownership changes hands, when we're purchasing stuff or selling stuff, either one. So I always think with these FOB problems, like the first question I need to answer for my brain is, am I the purchaser or the seller in this scenario? Because it really matters. It confuses. It's easy to get it confused. So if I'm the seller, then an FOB origin means as soon as I load it on board the transport, whether it's let's say a truck, I load it on the truck, then I'm going to take that out of my books and assume it goes into the books of the buyer, right? Whereas if I sell an FOB destination, it's going to remain part of my inventory the whole time it's on the truck, and it's not until the buyer receives it that I'm going to take it out of my inventory. And the opposite is true for the buyer. So when I'm the buyer and I purchase something FOB origin, then the minute the seller loads it on the truck, it becomes part of my inventory. Now, I'm not in real life, we're not so concerned about like logging it into inventory. It's usually a question of insurance liability. Like if there's an accident and the stuff is ruined or lost, whose insurance is going to have to pay for that? But it can become an issue at the end of the month or at the end of the financial period when I've put stuff on the truck to ship it to the seller, and then I've got to close out my books. Well, what are my assets? Well, anything that I loaded on that truck, if it was FOB origin, is no longer part of my assets, and so I have to take that out of there. Whereas if it's FOB destination, it could still be mine. I have to figure out what's the buyers received and what they haven't.
And then if it was FOB destination and I was the seller, insurance on that shipment is an expense, right? Because anything shipping it out is an expense.
Right. Yeah,
But if I'm the buyer, anything incurred in that bringing that to me is part of like the inventory cost.
Yeah,
right.
That's a good question, and I think one that confuses people too is when I'm a purchaser, I'm going to take all costs of purchasing, the cost of the goods themselves, the cost of any transport, the cost of any insurance while it's en route, and I'm going to roll that all into my merchandise inventory cost. Okay. Whereas when I'm the seller, then it's not really part of the inventory. It's a separate cost that's entailed in it. And so I'm just going to claim that as a periodic, shipping expense or insurance expense. That's a good question, and one that I think steals a few people's lunch money. Right? They're like, what just happened to me?
Brother Fox.
Yes.
This has nothing to do with this course and what it's teaching. However, I worked in international logistics. FOB to me meant that the shipment was free until it was on board the ship. I had the most difficult time trying to get the people I worked with to understand the term that they're using in that context is not what we're teaching here.
Okay, interesting.
Until we finally wound up getting billed numerous times for we paid to get to the container to the port. But with FOB, the way it was understood then is we also were paying an additional $600 or $1,000 to get that container through the transfer station
through customs and through everything. Yeah.
And so I'm wondering if that will be taught in some of our later courses so that there's a distinction made there. But it was hard because I was working with college graduates, and it was really hard because I didn't have a degree, but I had experience, and I kept trying to get them to understand FOB is not what you mean. Ex Works is what you mean.
Okay.
And again, this has nothing to do with this course, but just kind of heads up.
Recognize that logistics is one of these professions where many of the people who end up working in it are not people who were ever educated in logistics, right? They got a management degree or they got an MBA and took one course in logistics, their junior year in college or something. And then they end up being hired as a logistics professional. And oftentimes you'll find that the administrative staff who's working there know more about the actual ins and outs of it than the new manager. That happens a lot.
It was hard.
Yeah, I'm sure. So yeah, good point. And I will tell you that I think accounting is easier in the real world than it is in a class. There's never this, like, I don't have to, in the real world, when I order something from my supplier, I don't have to be like, am I the buyer or the seller in this situation? I know I'm the buyer because I just ordered it, right? like it's logical. But here, and again, I've said this before, and then how I feel for our students for whom English is a second language, because now they're having to sort through that entire concept and word problem in a foreign language, and that stinks. That's the technical term. It stinks. All right. So purposes of internal control systems. I mean, honestly, really,
I forgot about this chapter, bank reconciliations.
Right.
Thanks
so I was
to
gonna say, so this chapter is like, it's a little bit hard because it's mostly terminology, right? But then there's the bank reconciliation. And the bank rec is one of those things that like nobody does anymore, or not nobody, but we usually have software that just tells
Mhm.
us, oh, that cleared your account. And so I keep wondering how much longer we're going to be teaching it this way. But I think the main thing to remember for me from bank reconciliation is any adjustments I make to you remember what you're doing is you're starting with your book balance, your record, and then you're making adjustments for what was on the bank statement that wasn't yet recorded in your books. And then you also go with the bank's balance, what shows up on their statement, and you make adjustments for anything that you had changed in your own records that wouldn't yet be on the bank statement. So that usually means checks you've written that haven't yet cleared the bank, so they're already in your book, but they're not on the bank statement yet. Anyway, so the thing that really matters is any adjustment I make to my book, I've actually got to do a journal entry. I've actually got to make the adjustment to my book, right? I've got to actually record those. So when when the bank is collecting a payment for me, or when the bank is charging me a service charge, I didn't know about that. I mean, I probably knew it was coming, but I didn't know about it, that it actually happened until I reviewed my statement. And upon doing that, I have to make a journal entry to show that I've received that payment from the person who borrowed money from me or whatever. I don't know, any questions about that? Again,
Thank you.
my kids do just like, why would you do that? Like, just have it text you every time something clears your account with your balance. And so you're like, okay. And what happens when they don't write, I was gonna say, what happens when you write a check and then the person does deposit and they're like, why would I write a check? So, same thing like when I try to call my children on the phone and there's like, it goes to like the 7th ring and then they go, hello? Like, why would you call? Like, just snap me, dude. All right. Like, I'm like, certain things are easier to explain spoken than in writing, and they're like, name one, Anyway, so all right, chapter 7. So the allowance and the direct write-off methods for accounts receivable. So remember, accounts receivable is an asset, money owed to me. And the question is, we know that some people are not going to pay us. So what's the best way to deal with that from an accounting standpoint, right? The direct write-off method would be like, well, just wait till they don't pay you. And then once you decide they're not going to pay you, write it off. And in other words, claim it as an expense, and take it off of the or the asset, accounts receivable. The problem with that, of course, is oftentimes we don't realize they're not going to pay us until we've moved on to a new financial period. And so now we have this weird expense in a future period that doesn't match up with the revenue that we had created at the time when we thought we were getting paid, right? And so instead we use these allowance methods. The problem with allowance methods is they're confusing. If people would just pay us on time, if we just have an all cash business, we don't need any of this confusing stuff. But customers like to be able to pay later, right? Anyway, so they just want you to know how to journalize losses and write off accounts using both methods. And actually, there's more than one method to do the allowance method, right? We have, let's see here. I'm just looking
Either
at,
on sales or like it's a percentage of sales or a percentage of accounts receivable, right? Or
correct.
2 different ones.
Mm-hmm.
Okay.
Yeah. So one is like that you go, hey, based on our past experience, 3% of our sales is just uncollectible. And so what we do is at the end of each year, we tally up our sales and we multiply that by 0.03 and we write that off as an expense. So we actually, and then we create this allowance. Sometimes they call it like an allowance for doubtful accounts or an allowance. What do they call it? Yeah, that's what they call it in this class, right? So we debit the bad debt expense, we credit the allowance for doubtful accounts. And then the next year, anytime someone actually doesn't pay us and we decide we're not getting paid, we write that off to the allowance account and then the balance we put in the allowance kind of slowly comes down, and that helps us adjust for the next year. Oh, maybe it's not 3%, maybe it's 2.8%. So that's one way of doing it.
Brother Fox, I've
Yeah.
tried to understand what is the point in doing that. And I wondered, is that so that you can create your business plan for the following year?
Honestly, from an accountant standpoint, the only real reason for it is so that we can claim the expense for the bad debt, what we think we're not going to get paid on at the end of this year, because this year is the year that we collected, that we recorded it as a revenue.
Okay.
And so we want to offset the revenues with any bad debt expense in the current period.
Okay. All right.
And then we do that allowance. In the next period, we can say, well, was that offset correct, or do we need to adjust the amount? When we're doing an allowance that's based on the balance of our accounts receivable, we do that a little bit differently, because we usually only journalize an expense equal to the amount we need to bring our accounts, our allowance account, up to a certain dollar amount that's a certain percentage. I know that's really confusing, sorry. But so if we say, hey, our past experience tells us that 5% of our accounts receivable is not collectible, just people aren't going to pay. So what we do is we look at the balance at the end of the year of our accounts receivable account, multiply that by 0.05, and then we look at our allowance for doubtful accounts, and that will already have some balance in it from the previous year. Okay. And so all we're going to do is we're going to do a journal entry to bring the balance of that account up to that 5% of our accounts receivable. And so often that's what's a little bit different about it than the other one. And then they also give you the aging of accounts version, right? Where you say, instead of just saying we're not going to collect 5% of our accounts, you say, well, we're going to collect 99% of our things that are 0 to 30 days past due, but we're only going to collect 95% of stuff that's 30 to 60 days past due. And experience tells us that anything gets past 60 days, we're only going to collect 60% of that, because that's when we know people aren't paying. And so that's, if you remember those problems, it's where you're kind of factoring out the amount owed to you with more detail.
Is that, are we going to do aging on the exam? Are they going to ask that?
That's a great question. Let's see.
Thank you.
Compute bad debt expense, journalize write-off accounts receivable using the allowance method, journalize collection of accounts receivable previously written off,
We'll see.
compute. It doesn't, I don't think so. Recognize though, I mean, if you can figure out the percentage of your total accounts receivable, you could also figure out the percentage of broken down. It's just more steps. It's easy, right? Yeah, I'm probably getting off track of this a little bit. I'm just sort of reviewing each concept instead of sticking to the bullet points here, so I apologize. So into chapter 8, this is stuff we've covered more recently, right? And so it's starting to be part of our memory here. So we need to know which costs are capitalized versus those which should be expensed. And so again, any costs of acquiring an asset or getting it ready for use are capitalized. Once we have an asset in use, then really only costs that are going to extend the useful life of the asset, or I don't think they say this in the book, but the other thing is if it manifestly changes the use of the asset in some way, like let's say we build a wing onto a building, we would capitalize that. Even if the building's not going to last any longer, that changes the building, by adding square footage to it or something like that. So
It's all those betterments.
Oh yeah,
Betterment.
I hate that term, but yeah, that's what this book uses. Like it's a betterment, made it more betterer than it was before or something.
Oh.
So yeah, so just saying anything that extends the life of it or betters it, makes it more useful, I guess.
Okay.
Those will be capitalized versus things that and recognize that think of a vehicle, like an oil change, that's gonna, in your mind, you think, oh, that's going to extend the life of the vehicle. And the answer is not really. It's going to instead let the vehicle last as long as it was supposed to last. So it's just maintenance. Maintenance doesn't, it allows an asset to live as long as it's supposed to live. Whereas if we put a whole new transmission in a vehicle, that's not maintenance, right? That's going to extend the life of that vehicle. So and what's hard about this is in real life, there's things that are like clearly capitalized costs, and there's things that are like clearly expense costs. And then there's this weird gray area, right? And you can work at one company and they'll call something capitalized and move to another. And they're like, oh, we don't capitalize that, we just expense it. And so that's challenging at times. The place where I work right now, they have an unusually long life on things like computers that I think are 3-year assets, but they think are 5. So you just have to get used to what they're doing there. Again, what costs that are parts of lands, building, or equipment. Recognize that we usually buy property as land and buildings together. And so there's that process, which you learned about, of sort of separating that out by getting it appraised and saying, okay, 40% of the cost was the building and 60% was the land, and then applying those percentages to what you actually paid for it. If you remember that from the homework. We need to be able to do depreciation and recognize that sometimes we have partial period depreciation, right? Like when we sell an asset, we have to, in the middle of the year, or we buy it in the middle of the year, we're not going to do a full year's depreciation for the asset.
Can I take you back a minute? I always get tripped up on, I bought a piece of land and there was an old shed on it. The removal of the shed, is that considered part of the building, or how do I handle that?
Are you talking in real life or a problem?
Both, because that's a scenario that we've been given.
Sure. And so are we building another building on the property?
Right. So
Okay.
they're removing this old building so that they can put something else on the land.
Yeah. So
I think
I don't know the book answer.
I think the book counts that as land cost.
Okay, I was gonna say, I would call that land cost in the sense that what we're doing is just preparing the land to be able to be used for something else. So,
Okay, thank you.
anything that's like clearing off old debris or cleanups, certainly. Now, if that old building were to be, we were gonna add on to it and make it a bigger, newer building, that would be different. We would call that, but as far as the purchase price, any costs of putting an asset into service. So if I buy land that's full of junk or full of an old building, then clearing that off is going to be considered part of the land cost.
Okay.
Yeah, so I think there was one where it was like the cost of getting rid of an old building, grading and leveling, all of these different things, and then the actual construction. And the only thing that was actual cost of the building was the construction. Everything else ended up being put in the cost of the land itself.
You're right. Thank you. That's the one that got me.
All right. As far as depreciation goes, recognize that you always have to know these variables: cost, salvage value, right? What would the asset be worth, if for lack of a better term at the end, useful life, and then the method of depreciation we're going to do. Like, for me, like, I know when I teach business statistics, and like, I always have to try to break out what are the variables in play, right? And those are the variables in play. So cost, salvage value, useful life, and the depreciation method. And then they're going to want you to be able to do straight line, declining balance method, and units of, what do they call it? They call it
Units of production.
units of production. Make sure you can do all of those types. You just need to know the methods and how to apply them. Remember, accumulated depreciation is just what it sounds like. It's any depreciation expense of the current period added to any depreciation that was taken in previous periods, right? That's what accumulated depreciation is. And then our cost, what we paid for the asset minus the accumulated depreciation, is what we call our book value. And so we're going to see questions that probably ask you about book value. And anyway, compute the gain or loss on the disposal of an asset. So that's going to involve your cost, your accumulated depreciation, any money you receive or pay for the disposal, and then the gain and loss. Those are the four things, right? So because again, it's just your book value, and if you got paid more than the book value, you made a gain, and if you got paid less than the book value, then you had a loss. But the book value is a function of cost and accumulated depreciation. For me, some people like to do it like it's a math problem. They'll write cost minus accumulated depreciation gives me book value, and then minus, what I got paid for it in cash gives me my gain or my loss. Other people like to do it in a journal entry style. That's what I like to do, where I know that I'm crediting the full amount of the asset and debiting the full amount of the accumulated depreciation. And then I'll be debiting cash if I receive it, or crediting it if I have to pay for the disposal. And then I just know that the amount that makes it balance is my gain or my loss. And if it's on the debit side, that's a loss because that's where the expenses go on the debit side. And if it's on the credit side, then it's a gain because that's where revenues go. So again, I think both methods are good. I think my brain has been thinking in terms of journal entries so long that fits my brain better. I can't tell you which one I liked better when I was first learning it. All right, chapter 9. Oh, also recognize this idea of intangible assets, right? Things like patents and copyrights and things like that, that when we amortize those, that is the same thing as depreciation. I think the term confuses people. Amortization is the same thing as depreciation, which is just a recognition of the cost of an asset spread out over its useful life. And when we talk about amortizing intangibles, it's always done in a straight line. I don't know why, but they always do it that way.
And that's always just like, because there were plenty where they're like, they bought an 18-year patent, but they're only going to use it for 5. Like the useful life is 5. Then
correct.
Right? It's not 18.
How long you're going to get value out of it.
Okay.
Mm-hmm. Yeah, I mean, think of buying, if you're a rental car company and you buy a brand new car, that car probably has a useful life of, when I buy a car, it has a useful life of 200,000 miles. But if I'm a rental car company, its useful life to me is probably only 50,000 miles, at which point I'm going to auction it because we got to keep late model cars for the customers or whatever. So it's the useful life to you, not what it could actually last.
Okay, that makes sense.
Accounts payable versus notes payable. Typically that means less than a year or more than a year. Okay, if it's something, and also look, that notes payable are more formal by their nature. We actually draw up a note, an agreement that says you're going to pay me this much interest for this amount of time, and that notes payable almost always charge interest, and accounts payable almost never do. So accounts payable are like these informal relationships between a supplier and a customer, where it's just like, hey, you have 30 days to pay me. Anyway, so that's the differentiation between them. Payroll taxes versus payroll withholding. I think that confuses people sometimes. Recognize that the employer has certain expenses, which is, the federal unemployment, the state unemployment, and their half of the FICA and Medicare of the Social Security and Medicare taxes. Those are payroll taxes. That's what the employer has to pay. Whereas the withholdings are all the parts that the employee is paying. So their half of the Medicare and Social Security, plus, if they pay insurance or if they're having any, charitable contributions withheld from their check, all of those sorts of things.
So it's being withheld, and the employer is then paying it on behalf of the employee.
Right, but it's not an expense to the employer,
Employer,
except for in as much as it was a payroll expense.
the
'cause
whole
right.
expense. Okay.
Right. Yeah, so not only do I have to pay the people for working with me, but I have to pay the government for the
Mhm.
joy of letting
them.
them work for me, right? Thanks, government. But at least we know they're not wasting it, so that's a comfort.
Right. They're putting it to such good use.
Right. We will fund the UN or something. All right. Sorry, that's a controversial topic. I shouldn't have gone there. It's just in the news right now, so I'm like, I love supporting things that I wouldn't support with my money if I had a choice, right? That's why it's hard. All right. So let's see. I think that's pretty good, unless there's other questions about those. Chapter 10. So this says know the criteria to be met for a liability to be recorded. So this is just that whole thing of like, is it probable, likely to happen? Is it estimable? Can we guess how much it's going to be or make an educated guess? And that, we make those estimations based on past experience. Again, distinguish between long-term and current liabilities. Again, 1 year is kind of the magic number. If we expect to be paying that debt within the next year, we typically call that a current liability. If we expect to pay it in longer than a year, it's long-term.
One that got me was you're making a payment on a long-term note. How did they word that? You know what I'm saying?
Portion of a long-term note.
Current portion of a long-term note, and every single time I'd put it in the long term and I'd get it wrong, and it was like, I think I got it now.
Yeah.
But even though it's a long-term note, if you're making a current payment, that goes in your current liabilities, not
right.
your long-term.
Right.
So anything that would be paid on it within the current 12 months
Right.
would be current.
Right. Yeah, and it's usually listed as the current portion of long-term
Yeah.
debt or
Mhm.
something like that. But
There's your sign.
if you think about like your home mortgage or something, it makes sense, right? There's a portion of that, and the whole intent of reporting this on like an income statement or a balance sheet, this would be on a balance sheet, is that, so say someone who's thinking of investing in your company has a clear understanding of your debt situation. Long-term debts don't scare me if I think I have long-term ability to earn capital and pay them, but money coming due in the next year, we've got to be able to pay that, right? And so it's only fair that we would tell a potential investor, oh, of all this money I owe, this much of it's due in the next 12 months.
Yeah.
That's the intent. Bonds. So again, our par value, our stated rate, our market rate, and the annual interest. Those are going to, we have to understand all those terms, know how to compute the after-tax cost of bond financing. And then, so interesting, remember I said there's no ratios. Apparently that doesn't apply to, it says compute the current debt to equity ratio.
So there's that one.
There's that one, yeah. I don't know if it's because it's these later chapters, so they were like, oh, we can do what we want. So be aware of that, I guess.
And that formula is just current debt divided by total equity, right?
So I don't think it's current liabilities. It's total liabilities divided
Total
by
liabilities
total
divided
equity.
by total equity.
Yeah, okay. What they're asking for here, current debt to equity. So if it says current debt to equity ratio and it says that term, what I don't like about that term is I could be saying, what is the current debt to equity ratio? Or I could be saying, what is the current debt to equity ratio? I think it's going to depend on what they're asking for. Typically, we more commonly use just a debt to equity ratio, which is our total liabilities divided by our total equity. But I would review the book on that to be sure. Okay.
Debt to equity, it was total liabilities divided by total equity.
Right.
Okay.
But did they have a current debt to equity in there in the book?
Oh,
See, them putting that in all caps makes me think,
Yeah, that's kind of, okay.
but I would check, because I've never, I don't believe I've ever calculated that. Why it's such a good ratio is if you think about your, back to the financial, the financial accounting equation, assets equal liabilities plus equity. Okay, so what it does is it tells us how much of the business's assets as a percentage, because if that's a 1, that means that our debt equals our equity, right? So 50% is ours and 50% is the bank's, so to speak. And if it's less than 1, it tells us we got a problem, that our assets are owned more by the bank than by us. And if it's greater than 1, I'm sorry, I take that around, turn that around. If it's greater than 1, the more is owned by the bank, and if it's less than 1, the equity is the heavier side. So it's a really great ratio, but I'm a little confused by them having current in capitals with the rest. So
Current ratio, just FYI,
right,
on page 500, current ratio equals current assets divided by current liabilities. So
right.
is,
But that's from way earlier in the book.
yeah,
The
So
chapter
probably
10.
just
Chapter 13.
total liabilities divided by total
I
equity.
think they're talking about the debt to equity ratio.
me too.
What is the debt to equity ratio currently, like that?
Okay.
Okay, I'm
Understand
gonna
that.
do this one.
So chapter 11, this is more informational stuff, the process of incorporating a company. Honestly, if I have to incorporate a company, I hire a lawyer to do that because it's fairly complex. I hate paying for it, but we've done it a couple times and I just don't want to screw it up, right? I've not only do you have to file a corporate charter, but the corporate charter has to be created correctly. And then you have to file annual filings and all of these things. This is why so many people choose to be like an LLC or something that doesn't have so many rigid requirements. Par value, stated value, and fair value of a company's common stock. So this is confusing because all the par value means is an amount set per share in the corporate charter that has no relation to the actual market value or fair value of the stock. Okay, and so oftentimes, and some states don't even require it anymore, but oftentimes you'll see that there'll be a par value stated. That's confusing. A par value listed in the corporate charter, and stated value is pretty much the same thing as par value. Again, it's like this arbitrary value of the stock given in the corporate charter. When we speak of fair value for stock, what we're talking about is its market value. How much could you sell it for today at the market? And so that matters, right? When we're listing on our balance sheet the stock, because we'll list common stock and then we'll list it at its par value, and then any money that we were able to sell it for in addition to that will be listed on a separate line called paid in capital in excess of the par value. And so what's hard about describing that is just recognizing both par value and stated value are really arbitrary. They're just some number that they had to commit to when they created the corporate charter, and then forevermore have to list the value of their common stock on their balance sheet at that amount plus any amount over and above it. That was a really long explanation. I don't know if it was useful.
Page 413.
What's that? We're
Page
almost there.
413.
Okay.
Yeah, if you didn't get it, listen again on page 413 and it'll
Okay.
help.
Okay.
They're
And
talking
so
on the balance sheet, right?
yes. And so that last bullet point is that you need to know how to journalize that issuance of the common shares, including what part of it is recorded as common shares or common stock and what part is recorded as paid in capital in excess of the par value. Statement of cash flows, everybody's favorite. Didn't they present 12 early, right? In this course, they did like
11 and 12. It was like 1 and 2,
right.
11 and 12 were very first.
Right. And just so you know, by doing that, what they did is they gave you a very not deep intro into those things. In other words, most courses, what they do is they wait till the end and then they go much deeper and you learn about other types of stock, like more deeply, and the statement of cash flows is usually the hardest chapter. In fact, I always start my managerial accountings off with a review of the statement of cash flows and a review of the whole accounting cycle, because it never leaves, right? Anyway, so know the three components. So the operating activities section, the investing activities, and then the financing activities. Just recognize that operating activities is any cash we bring in through doing business, through selling stuff or services to people. And so any of that cash we bring in either through direct cash sales or for collecting accounts receivable, and any expenses paid out in cash. That's what our operating activities cash is going to be. Investing activities is cash that we pay out through the purchase of long-term or fixed assets or property, plant, and equipment. And then any cash we would make through if we sold off a piece of that, equipment or a building or something like that. And finally, financing activities are those activities where we're either borrowing money or issuing stock. We're raising money without actually, earning it through our operations. You can have negative cash flows from financing too, like if you pay off debt or buy back stock.
And dividends are listed in financing, right?
Correct.
Dividends paid would be a financing activity, cash flow.
Yeah, because it's a cost of, we issue stock to raise capital, and paying dividends is a cost of that means of raising capital.
Okay.
That was an hour and 20 minutes. So if you were sitting on a metal chair at state conference right now, your bottom would be sore, but your heart would be full. But depends, because sometimes when you have the little kids with you, you also didn't hear anything. You've just been keeping children quiet for an hour and 20 minutes. Anyway, at least with conference, you can roll back and listen to it later. With state conference, you're like, I'm sure there was some good stuff. It's weird as the kids grow up and you get to actually listen. Anyway, all right. So what else? Anything else? That was a long walkthrough.
It's very helpful though.
Yeah,
Thank
this
you.
is helpful, very helpful. Quick question, as I'm going through the supplemental videos, those concept videos, I noticed that there's points attached to them. Do those points mean anything at all?
They don't. Yeah,
Okay.
because it is confusing, because the way Canvas is set up, I don't know if you look at the way the categories are weighted, those are weighted at 0%. So any points you earn multiplied by 0, that's how much it affects your grade. But it is confusing.
Yeah, that's
So
crazy. And then I could not get question 11 on the quiz access this week. The last column where they were raising equity. Do you know which one I'm talking about?
I don't, but if you want, I can pull it up real fast.
Okay. It's question 11. And this is where we had 3 categories: don't expand, debt financing, and equity financing. And aside from not knowing how to do fractions, thank you for,
Thanks
like
for
I said,
taking me back
COVID
to
brain.
that
I was
horrible
just
part
like,
of my childhood. Yeah.
oh, I was like, okay, I can't believe I asked him that question. But I just couldn't get the net income on the equity financing. And I think my brain had just turned to mush that night. So
That is an interesting thing, right? Is like there'll be times when you're like, I can't do this. And then you'll come back later and be like, wait, why did this seem so hard in that moment?
exactly.
And there's other times when you come back and you're like, no, it's still impossible. So let's see. So we're going to look at number 11. Sorry. I don't love the way the scrolling is set up in McGraw-Hill, but hey, again, compared to the other things that can happen in our life, I guess bad
An overhead
scrolling.
projector. There
All
you
right.
go.
So let's see. Is this the one you're talking about? Or do I have the right one up?
Yep, that's
Okay.
the PV.
So no toxic toys currently has 350,000 of equity and is planning on $140,000 expansion. currently earns 122.5 in net income, and expansion will yield 61,250. The company has three options: do not expand, expand and issue debt, or expand and raise 140,000 equity financing. For each option, compute A, the net income, B, return on equity. Okay. All right. So you said you were able to get these, but not number three.
Yeah, the net, for me, the net income, I could not get that.
Okay.
So
So
there's
it's so yeah.
nothing-
Yeah, so it's what they're doing here is you're just doing like the things that would change, right? And so with option two, we're going to have this expense, and so the expense is going to, even though our net income will go, or our income before interest and interest expense will go up, our interest expense will also go up, so that'll render our net income somewhat lower. But with equity, I think what they're trying to get at here is with equity financing, you don't have to pay any interest, right? You're selling off a stake of ownership in the company.
Okay.
So that's all they're getting at. But then also your equity is going to go up because you sold stock, which is going to actually reduce your return on equity.
Okay. I see what I did wrong. Thank you.
Okay. Is that enough punishment for one night? Okay. Yeah, I still have to drive home in about 2 hours from here, from Tucson, where I'm at, to my house. But what that means is I get to stop somewhere along the way, maybe like a greasy truck stop, and eat food in peace without other people around. And I love my family, but on occasion, it's nice to just eat a meal by yourself. You could put
And
your
I'd rather have greasy food by yourself than them around. That's really good.
yeah, just put in my AirPods and listen to Hidden Brain or something. I don't know, some podcast.
Suit. That'll go over really well.
What's that?
In a truck stop in a suit.
Yeah, I brought a change of clothes. Anyway, we'll see. Anyway, all right. Well, thank you. Thanks for being here, and for, I guess, for caring enough about the class to give it your very best effort. That's something. And I've seen it over and over again, how the Lord blesses us, not always with the grade we want, or but often with the things we needed, right? Sometimes you want the things you want, and I guess sometimes you get the things you want, but we always get what we need. Just the timing's hard sometimes. What was that?
I'm grateful that I'm passing, because when I read your announcement and it said, even if you are not passing, by sticking it out to the end, you are learning and will be better prepared to succeed in the future. I stuck my tongue out at you. And I have read that to like 4 people. I'm grateful that I'm passing, but that's like, oh my gosh.
I shouldn't have put that, huh?
No, edit that next time.
But it is amazing to me, because I think, especially when I was college age, if I had been failing at this point, I would have been like, screw it, I'm not doing the final. Why would I do that? And I think now I would be like, I know I'm gonna have to take this class next semester, so I really should take the final, and really should, without cheating, try to take some notes, at least on concepts that will help me get through this the next time around.
Know what I'm in for next time.
Yeah. Whereas if somebody had just quit halfway through, which, again, there's valid reasons, you have life and other things, but then it's going to be just tough the next time around, because they're going to have to still. So I really did mean that, but yeah, I guess I could see how that could be a little discouraging. Anyway.
I took Cycle of Cash and I hated that, but it helped me so much, because I didn't take anything else besides that to be in this class, and at least I knew the jargon.
Yeah, no, and it kind of covers the first few chapters. Yeah.
Yeah.
Okay. So let's see. I'll offer the closing prayer, and I guess it's kind of weird in the lobby of this hotel, but whatever. Okay. I'm not afraid to be weird. Our dear Father in heaven, we come before thee in gratitude for this great conference we've had this last week, for living prophets on the earth, for temples, and an increased understanding of the importance of them. for increased understanding of the importance of missionary work and the opportunity to gather in Israel on both sides of the veil. We're grateful that we have BYU Idaho, where we can share these things as well as share subject matter from our courses, and that we can try to bring those two things together and become better disciple leaders in thy kingdom. Father, I ask thee to bless these students as they prepare and take their final exams, that they can do their very best, and that thou would bless them and help them to learn as thou hast commanded us to do, to seek learning. We love thee, and we say this in the name of Jesus Christ. Amen.
Amen.
Thank you.
All right. Thank
Thank you,
you.
Brother Fox.
Have a
Thank
great
you.
night.
Have a good night.
Bye. Have a good life.
Yes. Thank you. Bye-bye.